Good day, fellow investors. This is going to be fun. I have four more than $1 million portfolios, retirement portfolios to check. Let's immediately start with portfolio number one, the ETF diversified portfolio. If you look at things here, okay, we have 868,000 in the brokerage account, and then the second part is in the IRA account, 1 million there, so almost 1.9 million. I have miscalculated a little bit the percentages there, but it will give you a good picture. It's 26% in cash, okay, and then we have ETFs, some bonds, some gold, and two stocks. Let's dig into it. With cash, okay, 4%, nothing wrong with it, so 26% in cash, that is, let's say, a personal matter, depends on how much cash do you need for living, for retirement. These are all four portfolios of people close or in retirement already. But on the cash side, we know that cash is losing purchasing power. You're getting 4%, but real inflation is 4%, so except for those, if it is costs of living of whatever, long term, if there is another inflation hit, you can again lose, especially if they print money. So long term is not smart. Short term, you have to see, okay, how much you really need it. But I have said, okay, let's put it, it's safe, it's Warren Buffett style, that are similar, so I'll do them in one. The Capital Group Global Growth Equity ETF, okay, US equities, global, diversified, focused on growth. Then you have practically there the whole AI bubble now that you are invested in. Okay, so 20% of this portfolio is purely an AI bet. I hope that the 20% exposure is because this was bought 2-3 years ago. Now it's a double, and therefore, okay, you leave it there, diversified ETF, and okay. However, the risk and reward, I've seen these bubbles pop so many times, so maybe this time is different, but maybe this time is different is not something you want to count on when retiring, no? Because all these stocks are all-time highs, valuations are crazy, so yes, it's great businesses, all good, but just too risky for a risk and reward perspective. Dividends ETF, dividend ETF, but then I look at the, again, exposure, the dividend yield, and then we have, again, same names there with a little bit different, okay, we are there, banking, something like that. High exposure, always with the most expensive businesses. And then if you look at the real dividend yield, 2%, okay, it's better than the 1.2% of the S&P 500. But 2% is still nothing. Okay, expense ratio is nothing, but one of my dearest friends always says, be careful, when you pay peanuts, you're most likely to get monkeys. Anyway, 2% dividend yield is not a dividend yield. Yes, it can grow, but compared to the price you're paying and the cyclicality of businesses, whatever happens, you're again basing this on the hope that the next 10 years will look like the last 15 years. Too much risk for too little reward. Small caps, now again, great performance there. But if we look at the businesses there, we have discussed Interactive Brokers 2 years ago when it was cheap, now it is expensive. So always when you go to these ETFs, you're always buying most of the already expensive because of market valuation and things like that. The returns have already been made, now it is expensive, thus again high risk for small reward. Emerging markets should be cheaper, however, okay, we are now much better where the price was there, but stable there. I don't think there is a great dividend yield because they are again buying the most expensive. Then we have 2.5% in bond ETFs. Here I really want to show you this. The dividend doesn't justify the drop, let's say, when interest rates change. So you're, again, basing your returns on interest rates changing. Again, betting and not really investing. You can see here, it's just dividends at best minus the fees. So also with bonds, not really my kind of thing. I think I forgot the emerging market exposure there, so it should be there in the middle, but okay. Remember, keep in mind the emerging market, which would be, let's say, a neutral exposure. Now, 2% gold with ring. The problem here is that when it comes to diversification, I think Ray Dalio and also we always discussed, if you want exposure to gold to have an impact on your portfolio, it should be at 7%. If they got the exposure here, it means it was 1%, so not enough diversification. As it doubled, it's just a 1% portfolio gain and not at all exposure. Now here, the job has been done from gold. Now it's time to reduce gold, but it's still just 2%, so not significant. Global equities, same TMSC, things like that. So nothing spectacular there. We go to the 7% exposure there. I hope it was bought here or something like that, not here. Now, again, high risk for uncertain rewards, which is again something you don't want in your retirement. So when I look at this, when I sum things up, this looks like diversification because of the ETF financial industry that has sold you a good feeling that you are diversified. However, in my opinion, this is diversification that actually isn't. If you look at the names, if you look at the connections, this portfolio is not uncorrelated for diversification. Perhaps gold, but everything is in a bubble, so if things change, everything goes down, and all you have left is this cash. My idea here is, this is a $2 million portfolio. Worst case scenario, crash or something, there is 26% of cash, which is, again, the most positive thing there, but there is the potential of a 35% loss. The average dividend yield is 1-2%, which is, in my opinion, not justifying that 40% potential loss in case of a crash. Because if you are at 2 million and then you go to 1.2 million, that's a huge also retirement hit. So that is the key question, whether you can survive that. The upside is 4% on cash, 2% of dividends, and then hoping that the growth that has been great over the last years continues for the future. That's too much risk. What would I do? I assume that the 2 million current portfolio has been enjoying the gains of the last 5 years, which means the actual portfolio a few years ago was 1 million. And then now you're at 2 million, and now you have to see, okay, are my 2 million enough for me to enjoy a pension? Charlie Munger always said, don't risk what you have and need for what you don't need. But that's the feeling I have with this portfolio. It's on the risk-on side. What would I do with retirement portfolio? I would go to 5 to 10% yields to give me security in cash flow, not hope, not growth hope. Maybe pay for a hedge if necessary for the growth exposure. Gold is too late, and I can get to 5 to 10% yields and carry the same risk, even perhaps less risk. That's the goal. But the yield makes you live a comfortable retirement. An example of that we have discussed in the quadrant. So you have Aker, you have here one stock that you can check in the video, Equinor, and some others. You can also check my portfolios in the description below for some other, let's say, higher yield, less risk ideas. Let's go to the second portfolio. I've got a message, 2 million, all my retirement money, all in the S&P 500. And that is also something that I think many have. And I can't argue. I've done 15% for the last 7 years. The S&P has done 14.5. Let's say we are there. S&P, no effort, just put it and forget it. Sven Carlin does a lot of research. You have to look for value, adjust for risks, etc., etc., invest internationally and things like that. So it takes much more effort. And for me, it's hard to compete with this because stocks always go up, no? However, if I look at the yield is 1.15%, and then you're saying buybacks, pushing things higher. Okay, if for whatever reason we return to the historical mean, that's 75% down. That's the risk. Perhaps even it could be 40%, but keep in mind this is retirement. And retirement is about yield, and this doesn't justify the risks. Because, yes, stocks always go up. But if we are here and 5 years from now, 10 years from now, you are 50% down in the gutter, half of your pension fund is in the gutter, and your yield has just increased from 1.2% to 2.5%, that's not a nice situation. That's the risk not justified by this yield. High risk, reward is hope that this financial environment, I hope it too for the benefit of humanity, that this financial environment continues, that I keep matching the market with all my work, and okay, that's life, no problem. I hope it from the bottom of my heart. However, that's also the hope of this portfolio. In my eyes, too risky, and I'm simply a value investor, and therefore I would value invest to my portfolio or put a hedge on it so that I'm sure that I will not lose my 2 millions, that it will not become 1. That we'll discuss more tomorrow. Let's go to portfolio 3. If we look at this portfolio, so the key here is we have a company, Fairfax, at 34%. We have Bill Ackman at 10%, 11% cash, and then these, okay, Google, again, now the stock price is higher, but these are mostly bets. So cheap Chinese financials and things like that. So these are mostly bets. If I look at Fairfax, insurance companies have had a bad time. Now they are enjoying their revival. However, not a specialist on insurance, but okay, they did great, 18.7% compounded book value per year. Prem Watsa, the Warren Buffett of Canada, all good, insurance-based, and last few years have been stellar for insurance. You can see here the profits and how it goes. However, there have also been 5 years of bad insurance years. They are expecting that these good times will even continue. However, insurance, as far as I know, has always been cyclical. And we can see sustaining our consolidated operating income for the next years at 5 billion. Okay, this is the key here, but no guarantees. However, if we ever go back to bad insurance times, not great insurance times, then the gains revert and everything reverts there. And you can see here there are bad periods and there are great periods for insurance. So that's the key risk, 40%, 35% of the portfolio into the insurance cycle that now looks great. How it will look in 5 years, I'm not a specialist. You have to check the average long-term cash flows, whether the stock is now cheap or not. I'm not a specialist to dig into that. Pershing, Bill Ackman, he will do his own things with the ups and downs. So, okay, no worries now. Now it's good. Maybe you can expand when things are bad. This is also US British pound situation, so I don't know what the USD situation is, but okay. Fairfax, extremely risky. Now, if the position was built here, that is genius. But if I look at the main concern in the email I received is managing risk so I don't lose a lot of money. This is not managing risk, this is not managing risk, and this is especially not managing risk. This is insurance, the bet on insurance continuing as is, not entering into a cycle like it can happen, plus other bets that are crazy. And if the goal is not to risk money, this is a very risk-on portfolio. And just to say on Fairfax, it can be great, but Berkshire has also enjoyed its insurance revival, and at 1.7 billion, Berkshire, the financial fortress in this world, is also risky, just because of the high price compared to things. And Warren Buffett is not doing buybacks. Warren Buffett knows the insurance cycles. He has been warning us with whatever conference he made. It can be bad a few years, it can be good a few years, and that's something to keep in mind. Portfolio 4, it's a stock-based portfolio. We have Berkshire, Nestlé, then some other companies that we can say a diversified stock market portfolio. Berkshire, I just told you, yes, it's a great business, but it will not give a good long-term return. 5 years risky outlook, so it will be volatile, I think, depending on what's going on in the future. It's never bad to have Berkshire in a portfolio, but from a risk and reward perspective, it is expensive now. Nestlé, I always told you, give it to me at a P ratio of 12. Okay, it's getting closer to there. The dividend yield 4%. Okay, not bad, but not stellar. These business development companies, I don't know them. I see there is a huge yield, high risk likely. And then if I look at this, with such small exposure, and I think there are other 150 companies, this is just owning the market. Okay, there are some things, but how do you know what will do well, what will do okay? On average, should do okay if you can handle the volatility, okay. If you have more than 20 positions, diversification is great protection against ignorance. Nothing wrong with that. However, accept also average returns and average market performance. You are not having that edge that will for certain lead you to your retirement, because yes, stocks have returned 10% for the last 4 decades, but stocks have also went down 60% in bad times. And this is what you have to survive. This will at some point come again. So look at this, 54% down over a decade, and this is what every retirement portfolio needs to survive. And you are not going to survive with the 1-2% yield or a 2% yield. You need cash to survive. You need a 5% yield to survive an eventual situation like this, and a -50 at your pension fund. Everyone feels rich because we are in a financial everything bubble, but you have to see whether your retirement style requirements can be based on a bubble. If the bubble bursts, is your quality of life in your retirement as expected? That's the key question to ask oneself. So I don't see the risks justified. Even it's hard after a 15-year bull market, so I can't argue with the S&P 500, but I don't see the low yield justifying the risks. Value creation is not coming from a fundamental perspective in these portfolios. It's coming from stocks always go up. That, when the cycle turns, doesn't happen anymore, and I hope the cycle never turns for all people like this that have their investments, retirements, pension funds, and things like that. I hope I'll remain wrong forever. I hope you enjoy this. We'll do more. I have more different portfolios to review. Subscribe. Check my portfolios on my research platform in the link in the description below. 21-day money-back guarantee. And think about adding more value to your portfolios.